Good afternoon, this is Sean Golding with Golding & Golding, here to discuss the basics of a criminal tax evasion investigation versus civil tax fraud. It's super common. Somebody may have made a mistake. Maybe they were sort of willful, reckless disregard, willful blindness, but without intent. And they automatically assume that they committed a crime and that they're going to go to prison. The IRS is going to come bang down their door, drag them out, throw away the key. Doesn't generally work like that, but sometimes some situations do lead to tax crimes and investigations and things like that. So why don't we kind of go through the main differences and what you may be able to expect and how to prevent it from happening, right? Because that's the most important. So the main difference between criminal and civil is that with civil, it's going to be limited to monetary penalties. Those penalties could be exorbitant, okay? Willful FBAR penalties can go up to 50% maximum value with a minimum of $100,000 plus. And there's lots of other different code sections, tax fraud, 75% penalty, things of that nature. But it's still civil. You're still going to get to go to sleep in your own bed. and that's a good thing, right? When it leads to a criminal penalty, criminal penalties can include monetary penalties, but they can also include a loss of freedom. You can get arrested, indicted, and possibly convicted. The IRS doesn't really pursue criminal investigations that much or refer them out to other agencies that often, but it does happen, normally a few thousand per year. Oftentimes, the way that the criminal tax evasion investigation will start is at the civil level. Now, when you've been criminally indicted, at some point, you're entitled to counsel and your Miranda rights and all that kind of stuff. But that's not how it works at the civil level. If you're in an audit, you can't really claim the fifth. I mean, technically you can, but you're essentially telling the auditor you committed a crime. So what happens is, if you're in an audit and you think there is some potential to be subject to criminal investigation, you got to be careful. You should have an attorney with you. The two main situations is an eggshell audit and a reverse eggshell audit. An eggshell audit occurs when you know the person being audited that there's something you don't want to tell the auditor that could be considered maybe willful and possibly even criminal. But you can't intentionally make any misrepresentations and omissions. Now, you're not required to do the job of the auditor for you, but at the same time, you can't make any of those intentional misrepresentations. So it's called an eggshell audit. A much worse situation is the reverse eggshell audit, and that's a situation in which the auditor already knows that you did something, and they're just testing the waters to see how you'll respond. They know that you have unreported accounts, assets, investments, or income, and they ask you straight out, with your best poker face, you say, no, you never heard of a foreign bank account, why would you need one, and all that kind of stuff. You could walk yourself very, very well into a special agent investigation. A special agent investigation is once the matter's been referred to the special agents who will conduct the criminal or quasi-criminal investigation to determine whether or not they believe it should be referred out for further, a criminal complaint being filed, indictment, things of that nature. So if you're in an audit and put it this way, if you're being audited and you did some criminal, sort of criminal kind of stuff, make sure you have counsel. If you don't, you go in by yourself and you're doing the audit, you think everything's going great, you think you convinced the auditor of something, but then you never hear back again. You try to follow up, see what's going on, you never got the 4959 or anything like that. Chances are, if the agent goes silent, that it may be referred out to the special agent. So, in other words, they're not going to tell you that they're going to investigate you. Rather, they just do it, and then you find out normally the special agents work in twos, and they'll approach you when you're not ready, and don't talk to them. When they come up to you, tell them you need your attorney present, take their card, and then request an attorney. Not from them. You got to go find one, right? They generally aren't going to handcuff you and take you in on the spot. It doesn't really work that way. What are some common types of tax evasion issues? The way that tax evasion works generally is that someone knows that they are intentionally and artificially reducing their tax liability and knowingly doing so. So you have some cash income, you don't report it, right? Maybe it's a construction business or a restaurant, any other business, but those are the common ones. Someone may embellish deductions, take deductions that don't really exist. Now, this is important. If you think you may qualify for a deduction and there's a basis for it, and you do it, and the IRS disagrees, that's not embellishing to the extent that there is an actual law you're relying on it. The IRS just may disagree with your position. It's not criminal at all. It's good tax avoidance. If you're knowingly putting in deductions that don't exist, you don't have them, but you're just putting them in there in order to bring your income down, well, that's generally a type of evasion. Falsifying a business. This is one that's come up a lot in the past 5 to 10 years. Someone will have a high tax liability, and then what they'll do to offset that tax liability is create a fake business, a fake consulting business, something service-oriented with lots of travel expenses and things of that nature. And it doesn't even exist. So falsifying a business is pretty high up there, and if you get busted, it could be fraudulent. And don't let any preparer convince you that you can do that. It's another common thing where you have ghost preparers. They're not actually signing your return. You go there, they'll tell you that they'll get your liability down. Next thing you know, you never hear from them again, and then you're audited, and it becomes a big issue. If you are out of compliance, you want to get into compliance before it becomes this type of headache, there are various routes you can go depending on whether you're willful or non-willful. That's the key phraseology you hear in this area of tax. Voluntary disclosures for domestic or offshore for people who are willful or can't certify under penalty of perjury that they're non-willful. If it's domestic with no offshore accounts or other type of money, it's normally just a reasonable cause submission. If it's international, offshore, foreign related, then you have various programs, the streamlined domestic offshore, the streamlined foreign offshore, delinquent international information return submission procedures, delinquent FBAR, and of course, reasonable cause. We have lots of free information available on our main website, goldinglawyers.com, and our other sub-websites. If it's appropriate, you can reach out and schedule a reduced fee initial consultation. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.